Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. This is Wednesday, the 30th of November. I'm Daniel Lam, your host for the podcast. Like I said yesterday in this podcast, there has been policy measures in mainland China every week over the last few weeks. And we did get more policies yesterday during the day, this time from CSRC, announcing new measures and lifting the ban on equity refinancing via A-shares. This quote-unquote third arrow is another positive support on sector liquidity and facilitates the introduction of new strategic investors. This helped the Hang Seng Index to go up by 5% yesterday, and once again, most likely challenging the resistance at 18,400 very soon. Now, the FAQ that I've been getting from internal colleagues and external clients is that shall they be buying Chinese property stocks or Chinese property bonds? Let's dig deeper into all these. We do acknowledge that measures from the Chinese government had helped to ensure timely deliveries of pre-sold homes, help the risk management of distressed developers, and improve sector liquidity. Sentiment on the sector has certainly gotten better. But don't forget that houses are for living, not speculation. That remains a core policy of the Chinese government. This suggests demand is likely to remain lackluster as home buyers stay away amid falling property prices and mobility restrictions. However, a gradual expansion of the qualified benchmark developers list is more likely, given the measures appear to be aimed at supporting higher quality developers. So we're retaining a cautious view on Chinese high-yield developer sector bonds. Many high-yield developers are likely to proactively seek bond restructuring amid liquidity challenges and limited funding channels, keeping a lid on the bond sector. Thus, we would use the recent rebound in bond prices to rotate exposure to high-quality bonds where appropriate. In terms of property sector equities, they have rallied following the announcement of the 16-point packages. Technically, there appears to be more upside in the short term. That said, we believe headwinds remain for a fundamental turnaround in the sector. Continued tightening of housing measures remain largely intact. Structural factors, including prolonged mobility restrictions and slowing population growth, are also expected to dampen property demand and hence hinder a sustained sector recovery. Like we highlighted yesterday, communication services sector is the most interesting sector in mainland China right now, with fading regulatory concerns and earnings beating expectations. That is all from me for today. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.